Here's something your financial advisor probably never told you. The moment you turn 73, the IRS doesn't just ask for your money. They force you to take it, even if you don't need it, even if it pushes you into a tax bracket that makes up to 85% of your Social Security taxable. They call it required minimum distributions. I call it the tax torpedo. And if you're sitting on a $500,000 IRA right now, you need to hear this. Quick note, I'm not a financial advisor. This is educational content only. Consult a fiduciary before making any decisions. But what I'm about to show you, this is the math they don't want you to see. Let's start with what RMDs actually are. At age 73, the IRS forces you to start withdrawing from your traditional IRA or 401k. They use a simple formula. You take your account balance. You divide it by your life expectancy. That's your required minimum distribution. Here's an example. You've got $500,000 in your IRA. At 73, your life expectancy factor is 26.5 years. So $500,000 divided by 26.5 equals about $18,868. That's your first RMD. You must take it. Or you pay a 25% penalty on what you didn't withdraw. Now, here's what they tell you. You spent 40 years deferring taxes. Now it's time to pay them back. Sounds fair, right? Wrong. Because this isn't just about paying taxes on your IRA. This is about a hidden tripwire, one that detonates your Social Security. But here's the thing most people miss. This isn't just about paying taxes on your IRA. It's about a hidden tripwire that detonates your Social Security. Let me explain how Social Security gets taxed. Most people think Social Security is tax-free. It's not. The IRS uses something called provisional income. Here's the formula. Take your adjusted gross income. Add any tax-exempt interest. Then add 50% of your Social Security benefits. That's your provisional income. Now here are the thresholds. If you're single and your provisional income is under $25,000, 0% of your Social Security is taxed. Between $25,000 and $34,000, up to 50% is taxable. Above $34,000, up to 85% is taxable. For married couples filing jointly, it's $32,000 and $44,000. Same rules. 0%, 50%, or 85%. And here's where the torpedo hits. Your RMD counts as ordinary income. It gets added to your provisional income. And if you're anywhere near those thresholds, your RMD pushes you over the edge. Now here's the kicker. And this is where it gets UGLY. Let me show you the math they buried in the 1983 tax code. Say you're married. You're pulling $40,000 in Social Security. You think that's safe, right? You're under the $44,000 threshold, but then your RMD kicks in. Let's say it's $20,000. Now here's what happens. Your adjusted gross income is $20,000 from the RMD. You add 50% of your Social Security. That's another $20,000. Your provisional income is now $40,000. You just crossed into the 85% taxation zone. So now, 85% of your $40,000 Social Security is taxable. That's $34,000. Add your $20,000 RMD. You're paying taxes on $54,000 of income. Even though you only withdrew $20,000 from your IRA, you just triggered taxation on money you already paid taxes on, money you earned decades ago. That's the tax torpedo. And between $25,000 and $34,000 for singles, that zone is even worse. Some economists call it the torpedo zone. Your effective marginal tax rate in that range and hit 46% because you're paying tax on the RMD and triggering tax on Social Security at the same time. Insane. The 1% don't deal with this. You know why? Because they don't have IRS. They have Roth conversions. They have trusts. They have accountants who cost more than your car. This system punishes savers. Period. So who gets hit the hardest? Let me show you 3 profiles. See if you recognize yourself. Profile 1. The diligent saver. You maxed out your 401k for 30 years. You've got $400,000 or more in a traditional IRA, maybe a small pension. You think you did everything right, but your RMD at 73 is going to be $15,000 to $20,000. And that RMD plus your Social Security, it triggers the torpedo. Profile 2, the widow or widower. You lost your spouse. You lost their Social Security benefit. Now you're filing as a single filer. Your RMD didn't change, but your tax brackets just got thinner. The same withdrawal that was manageable as a couple? Now it's a tax bomb. Profile 3, the part-time retiree. You're pulling $15,000 a year from a part-time job. You've got Social Security. Then your RMD hits. Wages plus RMD plus Social Security. It equals a tax nightmare. You're getting hammered from all sides. And here's a stat that should make you angry. 1 in 3 retirees pays taxes on Social Security because of RMDs. Congress knew this when they wrote the law. They knew. But here's what really gets me. If you're a widow or widower, this is especially brutal. You lose your spouse's Social Security. Now you're filing single. Your RMD didn't change, but your tax brackets just got thinner. The same withdrawal that was manageable as a couple? Now it's a tax bomb. And Congress knew this when they wrote the law. So, what can you do about it? Here's the good news. You have options, but the window is narrow. Strategy 1, Roth conversions. This is the big one. Between ages 60 and 72, you have a window. Before RMDs kick in, you can convert chunks of your traditional IRA to a Roth IRA. You pay the taxes now at rates you control. Here's the strategy. Look at the 12% federal tax bracket. For 2026, that's up to about $94,000 for married couples. If your income is below that, you have room. Convert enough to fill up the 12% bracket. Pay 12% now. Avoid paying 22% or 24% later. That's when RMDs force your hand. And here's the bonus. Roth IRAs don't have RMDs. Ever. The money grows tax-free. You withdraw tax-free. And it doesn't count toward your provisional income. No torpedo. Strategy 2. Qualified charitable distributions. This one's for people who give to charity anyway. At age 70 and a half, you can donate directly from your IRA to a qualified charity, up to $105,000 per year in 2026. That donation counts toward your RMD, but it never hits your taxable income. It bypasses the torpedo completely. If you're giving $5,000 a year to your church or a nonprofit, do it from your IRA, not from your checking account. Strategy 3. Delay Social Security to age 70, if you're healthy and you can afford to. Wait, this is powerful. For every year you delay Social Security past your full retirement age, your benefit grows by 8% per year. That's guaranteed. So between 60 and 70, you do Roth conversions. You live off the conversions or other savings. You let Social Security grow. Then at 70, you turn on Social Security. Your RMDs at 73 are smaller because you converted. Your Social Security is bigger. You dodged the torpedo. Strategy 4. Withdraw strategically before 73. You don't have to wait until 73 to start withdrawing. If you retire at 62, you've got 11 years before RMDs start. Use those years. Withdraw from your IRA in small amounts. Smooth out the tax curve. Keep yourself below the provisional income thresholds. You control the pace. Now, you might be thinking something. Why didn't my advisor tell me this? Good question. Here's the truth. Most advisors get paid on assets under management. If you convert your traditional IRA to a Roth, their fee shrinks. If you donate via a QCD, that money leaves their portfolio. I'm not saying they're all bad, but their incentives aren't aligned with your tax bill. The window to act is ages 60 to 72. That's when you have control. After 73, the IRS controls the timeline. Let me address some objections, because I know what you're thinking. Objection 1. What if I need the money in my IRA? Fair. You don't have to convert everything. Do partial conversions. Convert $10,000 or $20,000 a year, whatever fits your budget. This isn't all or nothing. Objection 2. What if tax rates go down? Look at history. Tax rates for the middle class have been stable or rising for decades. The 2017 tax cuts expire. In 2025, rates are going up, not down. Betting on lower taxes? That's a gamble. Objection 3. What if I die before RMDs? Then your heirs get wrecked. Thanks to the Secure Act, your kids can't stretch your IRA over their lifetime anymore. They have 10 years to drain the account. If they inherit when they're 40 or 50, they're in their peak earning years. They could pay 35% or 40% taxes on your life savings. The tax torpedo doesn't stop at you. It hits your kids too. Objection 4. Isn't paying taxes now worse than later? Depends. Run the numbers. Most break-even analyses show you come out ahead in 5 to 7 years, especially if you convert during low-income years, and you get peace of mind. You paid this taxes. You're done. But here's the thing nobody talks about. Some of you are thinking, I'll just leave it to my kids. Bad news. The Secure Act killed the stretch IRA. Under the old rules, your kids could stretch distributions over their entire life. A 40-year-old inherits your IRA. They take small RMDs over 40 or 50 years. Low taxes. Lots of growth. Under the new rules, they have 10 years. And if you were already taking RMDs when you died, they have to take RMDs every year for those 10 years. Then empty the account by year 10. All that income hits them during their peak earning years. It's brutal. So if your plan is leave it to the kids, you're handing them a tax bomb, not an inheritance. So here's what I want you to do right now. If you're between 60 and 72, you have a window. Not a big window, but a window. Print out your last IRA statement. Go to ssa.gov and look at your Social Security estimate. Then ask yourself this: do I want to pay taxes on my terms or the IRS's terms? Because here's the thing, the tax torpedo is real. But unlike an actual torpedo, you can see this one coming. The question is, will you move? I've put links to free RMD calculators in the description. No sign-ups, no emails, just tools. Because the system is rigged, but you don't have to play blind. You played by the rules. Now play the rules they wrote.